Hello and welcome to the channel if you're new, and if you're not new, welcome back to the channel. I'm Curtis, back with another investment video. Please, before I begin, hit that like button and also hit that subscribe button if you're new to the channel. Infinite Investors is about helping all new and non-investors make sense of the market. First of all, I want to say a small apology for the fact that I haven't been posting daily uploads. I've been sorting some stuff out for the channel, which should be coming up hopefully, in days and weeks and months to come, but also some stuff out privately as well. So I wanted to come back today with a topic that I feel, based off recent events, is quite timely, and that's the topic of diversification. But before I begin, let me give you a quick portfolio update. As you can see, terrible portfolio performance. All of it is pretty much due to recent events, as you guys know, about the China-Trump trade war. And so for the first time, my dividends is actually making up the biggest proportion of my return versus actual general capital gains, which is very interesting. I received a few dividends. I received a Man Group dividend because I sold a day after the ex-dividend date, which was timely. And I've also received, I believe, a Taylor Wimpey dividend, and I'm expecting another dividend today, which I believe is Lloyd's. It might come in the next few days. So that's the next dividends I'm expecting. And then after that will be Aviva and I think Imperial Brands or someone else. But yes, in terms of capital gain, it's not been great. And one thing I mentioned to you previously is that I'm overexposed into the UK industry. So most of my stocks are UK. If I just hide Man Group, as I liquidated Man Group, apart from 2 stocks that I hold and 1 ETF, everything has been very UK focused. So the topic of diversification becomes really important, because depending on what happens in the economy, your stocks can obviously fluctuate either positively or negatively. In the case of the China-US trade war, what we saw is that a lot of US stocks actually performed quite well during that period, just because of, if there's less imports coming from foreign countries from a US perspective, then US industries are protected, and so that gave more confidence to citizens to invest into US organizations, is the sort of short of that matter. But what you found is that Chinese industries or Chinese organizations, European organizations, and obviously British organizations took quite a bit of a hit. So I wanted to talk to you guys about diversification, and what rules there are around diversification and what you guys need to be aware of. What I will say from the bat is, if anybody tells you the ideal perfect diversification rule or play, I wouldn't say they're lying to you, but I will say they're misinformed, just because there is no perfect diversification play, and I mean that genuinely. There is no perfect play. There are better plays than others, but there is no perfect diversification rule. And so anyone that tells you you must have, I don't know, 50 stocks, or you must have 100 stocks, or you must have 30 Chinese stocks and 20 UK stocks, it's all conjecture, to be honest, as you never know which way the market is going to move. However, what I will give you is some key themes, some strong themes that have been backed up, and so hopefully you can use this as a way to judge your own personal portfolio. So when we talk about diversification, there's different ways you can basically be diversified. You can be diversified by sector. So that's, for example, investing in healthcare versus investing in banking or finance, as an example. You can be diversified by region. So that's investing in a stock in Europe or a stock in the UK versus investing into a stock in the US or a stock in China. And you can also diversify by asset class. So it could be that, rather than have a certain percentage in equities, you could have some in bonds or some in cryptocurrency. As you guys saw recently, I invested in Binance coin. That's a way to diversify. So I've invested in a cryptocurrency coin, and it's doing pretty well at the moment. I'm 22% up on that as of recently. So That's one way to diversify your portfolio. Um, what I will say, and it's probably the most truest way to sort of explain or give you diversification in the most simplest form. The easiest way to diversify is probably in an ETF. So if you invest in an ETF, most ETFs track a number of stocks depending on what the purpose of that ETF is. And that ETF might be, say, industry focused or sector specific, or it could be a broad market index tracker such as the S&P 500. Either way, if you invested in, say, an ETF that tracks the American market, an ETF that tracks the global market, an ETF that tracks top paying dividends, and an ETF that tracks maybe solar or something renewable, etc., you've generally got a quite a diversified slice of the market. So if you want your life to be easy from a diversification standpoint, and you don't really want to make that much of a upfront effort in trying to make sure your portfolio is rebalanced and as diversified as possible, then an ETF generally will be the way to go. What ETF to choose? Well, you guys will have to decide for yourself, but you'll have to look through the ETFs that are available on whatever platform you trade with, and obviously understand what stocks they hold. I've got a video on ETFs and how to do that as well, so I will leave the link in the description so you guys have the information on how to do that. And an ETF will be the easiest, most simplest way to diversify. However, if you also want to select your own stocks like me, and you are more of an active slash aggressive investor, where you like to have a bit more control, then there are a number of different rules when it comes to diversification. Now, the first rule I'll mention to you is the rule that I'm going to try and achieve. And the reason why I want to just mention this first to you is because it's out of the book The Intelligent Investor by Benjamin Graham. And it's considered, Warren Buffett co-signed this book. It's considered the Bible of the stock market, so to speak, the best way to invest, the best way to value invest, etc., etc. And one rule that they have, and it's, if you have the book, it's on page 114. It talks about having no less than 10 stocks and no more than 30 stocks. And then it gives a number of reasons of why that should be. If you have too little, then you're not diversified enough. If you have too much, then you're overly diversified, and actually your chances of gains actually then reduce. The approach that the book says is 10 to 30. I have about 12 stocks, so I am going to look to increase my stock holding, and particularly my US and Chinese stock holding, so I do have a bit more of a diversified portfolio. So that's the rule that I'm potentially going to try and achieve. Now, I'm not going to do it in my next round of funding. This is probably something I'm going to work towards over the remaining course of the year. What I will say, and what I will do also, is put this link in the description from Investopedia, which is a great resource on all things stock market. And they generally co-sign the rule, but it's slightly a bit more conservative, where they talk about holding 15 to 20 stocks at least within your portfolio. So again, I think the 20 mark seems like the safe mark when we're talking about diversification. Again, this is not saying having 20 stocks means you're going to get the best level of growth. This is just saying that you're going to be the most diversified, providing obviously you look at different sectors, different regions, and obviously different asset classes at the same time. When we want to talk about asset classes, one thing that's also mentioned in The Intelligent Investor is to have 10% of your stocks in bonds. So 10% of your portfolio in bonds. So that's another way you could potentially diversify. It then goes on further to say that if you're more of an aggressive investor and the market is bullish, have 75% in equities and 25% in bonds. And when we go towards a bearish market, have 25% in equities and 75% in bonds. So that's another rule to potentially consider depending on the times. Now, currently I wouldn't say we're in a bearish market overall, but I would definitely say we've had a bearish period due to the trade talks. But I think this is more an exception rather than the rule when we're looking at the actual state of the global economy. So with that in mind, I would probably say we're still in a bullish market. We still are seeing all-time highs in a number of asset classes. But what we have seen over recent weeks, based off the China Trump trade saga, is that bonds have started to rise. So the bond share price have started to rise, and people have been investing in bonds a lot more. And we've also seen that cryptocurrency has been on the rise, and cryptocurrency has been seen as a really strong hedge against, the economy, which is obviously fiat currencies and, run by the federal and the government and the Federal Reserve, etc., etc. So those are some things to potentially consider. When we're looking at long-term growth and emerging markets, one thing that is mentioned again in the Intelligent Investor book is that no more than 10% of your portfolio should be in emerging markets. An emerging market can be categorized as smaller economies with a high potential of growth. So it's not just smaller economies that will stay small. It's actually that these economies will be, not necessarily the superpower globally, but they will be very, very strong economies on a global scale. Countries like Brazil, many countries in Africa like Kenya and other places, and also many countries in Asia as well. So it talks about not having more than 10% of your portfolio in emerging markets. Now, the reason why I wanted to call it out is because there are obviously ETFs that track emerging markets, and there are ones on free trade. There's a JP Morgan, there's a Templeton, and there's another one. I think there's 3 emerging market products or securities on free trade. So again, it's just that if you plan to invest in any of those, the general rule that's coming out of the book is that it should be no more than 10% of your portfolio as a whole. But I will encourage you guys to have a look at different articles about diversification and see what works for you. The key thing that I'm definitely going to do is increase my US holdings and actually introduce some Chinese holdings as well. I may or may not introduce another ETF. Again, this is not going to be in the next week or month. This is going to be over the next 2, 3, 4, 5 month period towards the end of the year, whilst I, still want to manage my portfolio in the right way and make the right sort of decisions without being a bit too hasty. But then it's good for me to know that, maybe I should have 5 or 10% in cryptocurrency just to see what's going on. At the moment, my cryptocurrency is doing better than my whole entire portfolio in stocks with a lot less of funds. So if I just pull up my eToro right now, which you guys will not see on your screen, but I will just quote it to you. I invested in Binance Coin, which is currently at $29.66 at this current time. I only put $240 in, and I'm sitting at $52 profit. Now, if we go back to my portfolio, my capital gains from an £8,000 investment is £9. It's actually a bit more, but still, it's not even worth discussing. So 8,000 to get £9, or $240 to get $52. It's very, 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 very quick maths to see that actually being more diversified and having different asset classes can be a way to go. So I'm definitely going to take a look at the asset classes rule, personally speaking. I'm definitely going to take a look at it from a regional standpoint, and also I will probably try and dilute my banking and insurance shares just to make sure that from an industry standpoint, I'm not overexposed. As you can see, 28.6 and 24.9, the finance industry is making about 52 to 54% of my portfolio. So those are the things I'm personally going to do. But guys, have a look at diversification, read some articles, and let me know your thoughts on what you guys may do. In terms of what I'm going to do with the current state of the economy and my current stocks, I'm not going to do anything different. I don't believe I've chosen any particularly bad stocks. I believe this is an economic issue, and I do believe it will recover. So I'm going to keep on buying during my normal round of investing, and hopefully we shall see it rise in the future. But hopefully this video was useful. If you did like it, please like the video. Definitely get in the comments, and if you've got any questions, I'll be more than happy to help you. Just a quick plug, please follow Infant Investors on Instagram and on Twitter. All handles is / or at Infant Investors, sorry. And I will start posting more updates in that space as well. Other than that, take care, have a great evening, and last but not least, happy investing.